Hello, Earthlings. I'm seeking intelligence life on your planet. Obviously, there is none in this country called Turkey. I am Atilla Yeşilada, the front person for Real Turkey channel. And today we're going to talk about the Turkish currency, Turkish lira. Regular followers of this channel, which are as rare as intelligent species on this planet, would know that we're like plague doctors, really pessimistic. We hate everything that's Turkish, Turkish economy, Turkish politics, Turkish food, Turkish football called soccer. But today I'm going to surprise everyone by giving a relatively sanguine view of the exchange rate. The title of this video is A calm winter awaits Turkish lira. In fact, I'm going to go farther than that and claim that Turkish lira is going to appreciate throughout 2024. Now, I really hate to do clickbaits, but this is clickbait not because I want to make it so, but because economics, the whole profession is a clickbait. Now, when I say Turkish lira is going to appreciate throughout 2024, that does not mean that the dollar TL exchange rate, which is roughly 29 today, will fall to say 25 at the end of next year. That would be nominal appreciation. What I'm talking about is real appreciation. Interested? Keep watching. Okay, economics again. What does real appreciation mean? It means that Turkish lira against any given currency loses much less value than the headline inflation number. For instance, when I say Turkish lira is going to appreciate throughout 2024, if inflation in Turkey is 50% and Turkish lira only loses 40% against the dollar or euro, then my statement will be true. And that's what I'm talking about. Why? That question is very interesting to fund managers who wish to invest in Turkey, and there are many, but they're not convinced that the current economics team of Şimşek, Gaye Erkan, and Cevdet Yılmaz, their titular leader, will stay in their posts after local elections. Essentially, I'm going to provide what the accounting professional calls a uses and sources of funds statement. I'm going to try to prove to you that for the foreseeable future, inflows of currency, sources of funds, will exceed outflows of currency, uses of funds. There are three items that we need to look at. Of course, the current account deficit, the maturing debt payments within a year, and the portfolio choices of residents. That's whether the average Turkish saver wants to keep her savings in hard currencies or Turkish lira. Whether she keeps those savings in stocks or bonds doesn't make a difference. As long as they are Turkish lira, our uses and sources of funds statement remains true. Now, let's give you some numbers. Turkey has a current account deficit of roughly $45 billion as it stands, which is roughly 5% of GDP, and it's considered very high for a country which has a junk credit rating. Two, the Turkish state and private sector has to roll over or pay off $210 billion within the next 12 months. Quite onerous, you would admit. The biggest question mark is, of course, the portfolio choices of residents. Currently, roughly 60% of savings in the financial system are in hard currencies or in hard currency equivalent assets. In Turkey, this is called FX protected deposit scheme, where essentially you deposit TLs and the government or the bank guarantees you that at the time you want to redeem that deposit, you will be compensated for the loss of value in Turkish lira versus the dollar or versus the euro. So, let's go through these items one by one and see whether the central bank or Turkish economy at large have the capacity to sustain them, to pay them off without a noticeable depreciation in the currency. Start with the current account deficit. Yes, that's not that difficult. Central bank has gross reserves of $135 billion. If you have current account deficits of $45 billion, voila, it's financeable. Now, of course, experts among you would argue that, well, central bank reserves, net reserves, swap equivalents, gross reserves, doesn't make a difference. Central bank has usable reserves of over $60 billion plus $40 billion in gold. Any foreseeable number you want to plug into the current account deficit, central bank can pay it off from its coffers. How about foreign debt payments? Well, usually, if we can't borrow or renew our loans, then yeah, we're bankrupt, obviously. But that never happens. The convention is that, when maturity comes around, most loans are rolled over. Sometimes at a much higher refinancing rate or interest rate, but they are usually rolled over. In fact, as of September, the rollover ratio of Turkish banks and non-financials were 93%. So roughly they were borrowing to redeem their maturing debt. But even if the rollover ratio drops to 70%, it's not going to make much of a difference. Simply because Arab nations, which are suddenly very friendly, Mr. Erdogan, are coming through with promises of financial aid. Bloomberg broke the story first. United Arab Emirates is going to buy Sukuk issue, which is an Islamic bond. We don't know how much, but that doesn't make a difference. United Arab Emirates has a financing commitment to Turkey of $11.5 billion. Even a third of it arrives, it would easily compensate for the loss of funds that comes from low rollover ratios. That is, let's assume banks and private companies don't roll over 90% of their maturing loans, but 70%. As long as United Arab Emirates provides some financing, along with central bank reserves and potentially from financial investors who would follow in the footsteps of United Arab Emirates, that's really not a big problem. Of course, I forgot to mention one thing. My current account deficit and its financing calculation is based on a Brent oil price of $80 to $100. If Brent goes up to $120 and stays there for 6 months, every oil importing developing country is going to sink. There is no doubt about it. But even there we have an advantage. It looks like Mr. Putin and Erdogan still have a friendly relationship, despite disagreements on several areas like Azerbaijan, Armenia, Syria, etc., etc. And I would assume, and I think this is a reasonable assumption, that if we run out of money to import natural gas this winter, Gazprom, the Russian gas monopoly, will extend supplier's credit to BOTAŞ, our national gas monopoly, as it did last year. In return, of course, there would be unspecified favors for Russia. We'll probably have to allow them to build a second nuclear power plant in Turkey, which is a $20 billion investment. Now let's come to the last item. This is sort of like, the crunch time or the most important item. What if Turks suddenly want to convert a lot of their deposits into dollars? Or what if the $100 billion or so of money accumulated in this quasi-hard currency deposits suddenly want their dollars or euros back? Of course, then Turkey would be in trouble, because the central bank cannot suddenly find $100 billion of hard currency, can't even find $50 billion on top of current account deficit financing. But that's unlikely, because you would assume, barring a major disaster like, God forbid, another earthquake or Turkey entering a war, people base their decision to save in Turkish lira versus the hard currency based on relative returns. So hard currency returns 5%, dollars 5% deposit rate. But the new central bank governor, Ms. Gaye Erkan, on which I have shot 2 videos below, is steadily raising interest rates, which went up from 8.5% when she came to her post to 40% at last MPC meeting, and she will continue to raise interest rates. When central bank policy rates go up, deposit rates go up. Currently, on a compounded net of taxes basis, high net worth Turkish individual can get 55% or so on her TL deposits, which is still lower than inflation, but it's much more favorable compared to what she can get in dollars. And I think this is going to be the crucial difference this winter. In the past winters, we have had a lot of currency shocks, turbulence, turmoil, you call it whatever you want to, simply because Mr. Erdogan refused to allow higher interest rates. But this winter, central bank will tighten monetary policy further. And of course, banks will have to follow suit, which means they'll have to raise their interest rates. And of course, I don't want to, shoot a video that's too long, but when deposit rates go up, loan rates go up, people borrow less. When people borrow less, they import less. Okay? So we're fairly safe here. What kind of levels are we talking about? Well, I'm going to tell you. Volatility is going to be very low because Turkey is in a crawling peg system, which means the central bank controls the pace of monthly depreciation of Turkish lira against the dollar. And that pace is roughly 2.5% over the winter. I think at the end of the year, dollar TL will not be above 30. March local elections is another crucial date. Then it would probably not be higher than 32. And I think at the end of 2024, it would be extremely surprising if dollar TL exchange rate is above 40. So just to make sure that I'm telling you the truth, I expect 50% CPI inflation, and I expect only 40% or so. No, in fact, 33% of lira depreciation versus the dollar, which means lira will appreciate in real terms. That's, of course, damaging for those who export low value added items because their profit margins will be washed off. But it's good for the economy because it anchors inflation expectations, reduces the impact of imported inflation, and of course, as I've said, it also potentially reverses dollarization, the habit of Turkish savers to use their savings in dollars. All in all, I'm really surprised at myself, but I think Turkish lira is going to spend a very calm winter and potentially a very calm 2024. I want to thank all of you for watching Real Turkey channel. If you like it, subscribe or tell your friends that there's a channel here originating in Turkey that does English language broadcasting and tries to tell the truth, because I've never met the truth in my life. This is Atilla Yeşilada saying goodbye from Istanbul. And once again, I want to thank my partners in crime, Mesele Ekonomi, the premier economics and finance YouTube channel in Turkey, for helping me broadcast this video.